I think one of the coolest things about trading is the fractality of the markets. So whether you're a higher time frame swing trader or a lower time frame scalper, the same concepts will apply to every single time frame. So we can see here equal highs, buy to sell, lower low, coming into a level of supply mitigation. Equal highs, buy to sell, lower low, coming into an area of supply mitigation. So we want the same thing here, higher time frame, with this overall pullback into this level of supply to mitigate the last buying volume. So the same concepts will apply on the lower time frames as it does on the higher time frames. So we can see here we have swept ascending liquidity with this retail head and shoulders fake out, sell to buy into a level of demand, higher high. So what do we naturally expect? A higher low for a higher high, since we are counter trend trading within the lower time frame. So we identify two areas of demand. We come into the first one, unfortunately not the second one, but we can look for the reactions on the lower time frame to aid us in getting high risk to reward lower time frame opportunities. We identify the counter trend in the sequence, low, high, low, high, low, high, low, failed to make a lower low, and instead we broke structure and we made a higher high. So we look at the last selling volume before the structure was broken, aka the demand, and we can see we had two regions of demand, one in here, one in here. We would set half risk at this level, half risk at this level. Even if we didn't come into the second one, we just came into the first one as we did here. That is a 1 to 24.5 risk to reward, but we're using half risk. So that yields us just over 12% return. So if I scale out to the hourly time frame and we take price all the way up into that higher time frame objective region, we can clearly see that we came into that level very beautifully here for a 1 to 12 risk to reward. Boom, prop firm challenge passed, and I'll take my funded account, please and thank you.
Fidelcrest is an award-winning prop firm that funds traders with up to $2 million and offers generous profit splits up to 90%. So one thing that really sets Fidelcrest apart is their no minimum trading days requirement on their challenge and verification stages. On top of that, traders who successfully pass the challenge and verification stages are eligible to receive a bonus payout of up to $30K on top of their funded stage profit split payout on performance. And be sure to use promo code TradingNut, all one word, to get 10% off your next challenge. Click the link in the description below or the card above to find out more.
What's going on, ladies and gentlemen? Hope you guys are doing well. It's your boy Nate from Aerial Effects, back with another video. And in this video, it's going to be all about lower time frame trading and scalping. Is it possible? Can we do it consistently? So here I'm going to go over all of my personal rules when it comes down to lower time frame scalping in regards to smart money concepts. So if you haven't already checked out, go back. Last week's video was posted last weekend. Smart money concepts for beginners. I go over 3 basic rules that you need to follow to really simplify smart money concepts. Obviously, that was a more surface level understanding, but a very simplistic understanding that not many people will actually take into consideration. They oftentimes overlook the most important aspects of trading, and it's just the fundamentals, the simplistic concepts, just the basic understanding of what it is you're actually trading. So we talked about 3 things: market structure, liquidity, and supply and demand. So we're going to go through a little bit of a top-down analysis here on EURUSD, and then we are going to scale into lower time frame opportunities and try to find some lower time frame trades and go over exactly how I would break down a pair top down, but more specifically how we go about scalping smart money concepts. So the most important thing to understand is that the markets are fractal. The same thing happens on every single time frame. So whether you're a swing trader or a scalper, again, the same things happen on every single time frame. The concepts will still apply whether you're trading the monthly or you're trading the 1 minute time frame. So lower time frame scalping is definitely possible because of the fractality of the markets, but it comes with a lot more patience, confluences, and a lot more psychology that is needed in order to consistently churn profit from scalping smart money concepts. So let's get into EURUSD 4-hour time frame and let's kind of break it down top down. So very quickly, we have to go to the daily and the weekly time frame, check the overall direction, and this is where we're looking to trade, right? When price is in this specific region of price, I'm going to scale in here in a little while, but of course we're bearish. However, if we zoom out to the weekly, we can see that clearly we're bullish. We're making higher highs and higher lows. The most recent selling volume or the last selling volume before the higher high was really these two areas in here, right? This is really where the lower time frame structure was broken and we expanded again to make that higher high, right? So this is the last selling volume that failed to generate that lower low, and also this last selling volume here. So both of these levels pretty much create the two demand levels here that we're looking to potentially not only trade off of, but scale into for the lower time frame opportunities. So we've made that higher high. So when price finally came into that level, we weren't necessarily looking to just straight up buy it, but scaling into that level and waiting for counter trend lower time frame breaks of structure, utilizing the same concepts as we do with the higher time frames. So let's go down now to the 4-hour time frame, and as we're approaching this objective level, which is where price is going to be attracted to, we can continue to sell with the overall trend in the market with this external structure. And then once structure breaks internally via meaning lower time frame, we can be taking these lower time frame trends and opportunities back up into higher time frame objective. So those are the three things that are needed in order to trade and scalp lower time frames. We need to be trading with the current trend. We need a higher time frame objective, meaning where price is likely to be attracted to, which would result in a strong conviction for price moving in the direction you want to trade. But also internal structure has come into an external structure and a counter trend breakup structure is created. Obviously utilizing the same smart money concept principles that we do teach and talk about. So internal structure, meaning the lower time frame structure in regards to trend. So if we have a higher time frame external structure of lower lows and lower highs, the internal structure would probably look like this if we scaled into a lower time frame. So essentially, we are looking for an area, let's just call this level higher time frame demand, right? Price externally has come into the higher time frame demand and has reacted from it. Now we wait for the internal structure to break and then wait and see what kind of smart money concept plays we could potentially get based upon that break of structure and the pullback. Obviously, introducing time and price into the equation, which we will be talking about throughout this video today. So let's just break it down very simplistically. Just like we did last week, let's utilize just those three components, market structure, supply and demand, and liquidity, in order to pinpoint areas of interest of the external structure that we can look for reactions from, and then internally, within the internal structure, break that for more lower time frame, higher risk to reward opportunities. So we can see here, just applying the concepts, right? We had our last buying volume before the lower low. Right? So we want to be pulling back into a premium price to be selling it from that level. Now, what's interesting about this, and this is what I will go over in later videos, and this is what is called a type 2 manipulation. This is what Aerial Effects calls type 2. So we create buy and sell side liquidity. What we do is we run sell side liquidity to run the direction in the market in which it's going, run that liquidity, come back up, take the stop losses of anyone who is buying or anyone who is selling in here, run their stops, and then run the buyer stops who broke above this retail wedge pattern, right? So we run the seller stops, run the buyer stops here via selling, then we run the seller stops via buying, come up and mitigate at the right area of interest we should have been looking for originally, and then again we go and run the buyer stops with the continuation with the overall trend. So we come up into that level, and the same sort of deal applies. Where is the last buying volume before the lower low is created? Well, there's two in here. There's a lower time frame area and then this last buy to sell that kind of fills the imbalance. So obviously we didn't come up into that second level, but you could have had easily two potential entries with half risk each, having reacted off of that higher time frame level. So I'm sure there's lower time frame opportunities we could have scaled into. So continuing here, the last buying volume before the lower low was right in here, this area of supply. And look what happened. Just like we talked about last week, equal highs, buy to sell into that area of supply creates that mitigation and the manipulative move, buy to sell, because we have to take liquidity in order to free up the liquidity for the institutions to place all their bulk orders right at that particular price. So again, counter trend, the last buying volume before structure was broken, we made another lower low. We pulled back into the exact same thing, generated buy side liquidity first, ran that buy side into supply, created that huge buy to sell, and then made a lower low again. So now we have come into that higher time frame level. So we do have to be careful because we have come into that higher time frame level of demand. However, we still are lower time frame, in this case, bearish. So this most recent last buying volume before the sell-off here, and I'll just scale into the 1 hour time frame to show you. As we can see, this is the last buying volume that failed to generate the higher high, and instead we rolled over and made a lower low as expected, because not only did we sweep buy side liquidity, we came into that level of supply and we're overall bearish, right? So the external structure can be identified really right here as this high, this low, this high, and this is just intermediate supply. I mean, price could have come higher into that level. That is definitely the last buying volume for sure, but we can definitely be taking it off of this last buying volume. Why? Because this right here, just this general vicinity, is the last point of selling volume before we had that buy to sell. So that creates the demand. We've reacted off that demand, but we failed to generate a higher high in this sequence and instead rolled over as expected to make that lower low. So that creates the demand to supply flip, which I will be talking about in later videos. So what now? This is the external structure, lower high, lower low, counter trend, high, low, high, low, high, low, failed to produce a higher high, lower low. So after we create the overall higher time frame lower low, what do we naturally expect in the sequence? Well, of course, we expect an overall retracement up into that last buying volume, aka supply, in order to be looking for continuations short. So you can still be looking for continuation short even though you came into that higher time frame objective, because price has not technically broken structure until we close above that region, and as you can see, that's what happened as a result afterwards. So we can buy counter trend if the same concepts were to apply on the lower time frames, and we know the market is fractal. We can trade the higher time frames the same way we can trade the lower time frames. So when price created this high, failed to generate the lower low, and broke counter trend structure this way, and now we started to push up again, we can continue to buy, having the confidence that price needs to at least come up into that level before potentially falling. Now, since we're buying, we don't care if price was just to go long like it did. It ended up going long, right? We don't care. Why? Because we're buying in the first place. But if price is going to go against us, we need to be able to identify where that could be. And that's exactly why we have that overall objective. It's so important to have an overall objective. And that's that level right in here, which we came up into. So now we can have confidence that even if we were to go short, we still probably needed to come up into that level before falling. So let's scale into the lower time frames and kind of check out what price is doing in and around this level. Now I'm going to use bar replay to kind of get rid of everything here. I was going to take that away, and then we'll scale in. So lower time frame, we have created a high. We could have easily made a lower low and rolled over and maybe came back down into 0.93320, which was that other level of demand. But instead, if we zoom in, we will see that we created equal lows, or more importantly, liquidity. We also created a skewed retail head and shoulders. So we know retail trades these head and shoulders and wedge patterns and all these formations. And we know where the liquidity rests because we can see where they're placing their entries and stop losses. If we are told, if the masses are told to be selling upon a break of the neckline, they're going to be selling when price breaks and closes below this level. That's exactly why price is manipulated so strongly, not only to take out all the buyers that were in here, but also the sellers who are placing their positions there. Sell to buy, take their stops that are put probably above that swing high, and then they get stopped out of the market. So in order to move price long, they have to free up liquidity short in order to move price to the upside. So we swept the liquidity, sell to buy, and we broke, and most importantly, broke the counter trend structure. So lower lows, lower highs were broken. We finally made that higher high. So where do we want price to come back into? Well, we want to retrace back into our last selling volume before the higher high was created, aka this 15-minute level of not only imbalance, but demand. So that's where we wanted price to come into, and we can see we just failed to push into that. It doesn't mean it's invalid. It just means that price may return to it at a later time, and we can see the same type of formation occurring here. And I know it's blurry, I'm just zoomed out here. But as we can see, if we pull a trend line, 1, 2, 3, 4 touches, how many retail traders do you think are buying within this trend line? Probably a lot. And especially a lot of them are coming into their sell positions once the break of this, again, skewed head and shoulders pattern breaks the neckline, which it does right here. So not only do we break the neckline and entice sellers, we swept this prior low. We just failed to come into that level. We actually did not meet that level. So if we were placing our buy positions from that level, it would not have gotten hit, right? And we know that in order to trade lower time frames successfully, we need those swing points to be met. We need that external structure, meaning this level, to be met so that internally on a lower time frame, we can look for the same type of price action, the same concepts, and have way better risk to reward with it. So as we can see here, let's look at the counter trend. We create a low, we create a high, we create a low, so a lower low, a lower high. This is our last point of supply, and obviously we failed to generate the lower low in the counter trend sequence because not only did we, take retail trader stops, but we enticed them to go short upon the break of the neckline. We broke structure back to the upside, creating that higher high. So these two levels here, this last buying volume and this last buying volume, when we had reactions from it, this will turn into demand. All right, so this is where we want to be looking for price to pull back into, and then we can scale into a lower time frame to look for the same opportunities as we see on the higher time frame. So what happened here? Let's go back really quick. What time of day did this manipulation occur? This occurred at 8:30 a.m. Eastern Standard Time. This is prime New York session open or London, New York session crossover. I'm sure that was probably a news event, maybe a CPI or a monetary policy report or something that was created the excuse to inject volatility to take it short, to sell, to buy. News is not random. It is pre-planned. The news is just used as the excuse to drive price and do the exact same thing it was always going to do anyways. So that's why we had the sell to buy. All right, same thing here. This whole move occurred 3:30 in the morning, right? We had, or really this candle here, 3:15, was the inducement to attract buyers into the market upon London session open above each and every one of these highs. Because if the market was just trickling down here, if you were trading real time and you saw this, most retail traders would be enticed to buy it because we had a breakout, very strong impulsive move to start London session. But instead we rolled over. London session, we continue short, sell to buy. When did we start buying up? 8:30 in the morning, Eastern Standard Time. So we can have the manipulation, but also the mitigation from this level. Well, we didn't come into it, but if we did, just a couple more pips, it would have been the mitigation and the continuation for the rest of New York session. So again, we want to look for the same principles, time and price, within all the other smart money components to do it the same thing on a lower time frame. So these are our two levels of demand, and we can see we only came into the first one. That's fine, but at least we came into at least one of them. So let's scale in. There's no specific time frame to trade. We can go to the 10, 9, 8, 7, 6, 5, whatever we want, right? Just keep scaling into what looks good, right? So I'm going to go to the 5 minute because this is where it provided a very nice setup for us. So when price is pulling back into this level, what we need to be looking for is the counter trend, right? Internal structure breaking upon the retest, or not necessarily the retest, but just the overall, pushing down into the external structure. So this is the higher time frame level of demand. We came down, swept these equal lows with this push, and broke internal structure to the upside. So the counter trend is shown here, lower low, lower high, lower low. Yes, we came into it first, but we never broke and made a higher high. We made a lower high for a lower low and did the same thing, lower high. In this case, we failed to generate a lower low, and instead here we saw the break of structure because we broke the previous swing point here, having failed to generate a lower low from that level. So now we're trading with the higher time frame trend, meaning we have come down into this higher time frame level, as we discussed, 9595. We have failed to make a lower low overall. We broke counter trend structure back to the upside. So now we're trading with this time frame's trend, but also at the same time, breaking structure counter trend on the 5 minute after coming into these valid levels of demand. And then obviously we didn't come into this one. We kind of did here upon a retest, but we wanted to see a higher high before pushing down into that level. And then we broke lower time frame structure here. So in this case, we can apply the same exact principles to the lower time frame as we do with the higher time frame. So we come down and we mitigate at the perfect time. This is 8:25 or 8:30, essentially the same exact time as we saw all those other mitigations and manipulative pushes. This is London session, New York session crossover, preparing for New York session open, right? We come down last selling volume. This is the last selling volume. This is sort of what we call the repricing event. I'm not going to get into that, but it's called the repricing event. And here we can see it on the 5-minute. This is the last point of supply in which price failed to generate the lower low and instead made a higher high and we broke. So that would be a great retest region to push up and go long. We also had another level of imbalance, and it also happens to be the 50% of the imbalance from that wick to that wick down here. 50%, 9, 8, 2, 3. Right, so we can place multiple positions. Either you can just place one here with the stop loss here, or you could split it up, half risk here, half risk here. Stop loss at the second position's entry, and obviously placing your stop below the prior low. Because if price were to just come lower, well, then we would have gotten stopped out anyways, and we can expect price to continue short, but that's not the point. The point is we're following the same principles on the lower time frame as we do the higher time frame. So what we can see here is we failed to come into the second one, but we came into the first one, splitting up half and half. So 24.5% risk to reward, so 1 to 24.5. Cut that in half because we're using half risk. That is just a little over a 1 to 12 risk to reward, right, for that particular trade. And we can see that we just continued up. Now, the same thing can be applied here. We made the higher high in comparison to this swing point, but we didn't quite come into that level. This was the last selling volume, aka the demand that we wanted price to push into to mitigate towards the end of New York session. This is about 10:20 a.m. Eastern time. So this is when, New York session is at its kind of highest point. London session is about to close. So we wanted that last mitigation before the continuation, but we can see we didn't get that. So we continue to push up higher, right? We actually come back down into this overall demand, right? So we don't quite come back down into that level, but this overall demand, this overall swing point, the last selling volume that starts right there, we did mitigate pretty much to the T there. So we could have scaled into this position and tried to find an entry. Now, there wasn't anything here because the counter trend that was broken needed to push above that previous level, right? So we created the lower low and then we made the higher high and we never looked back, all right? So if we scale back out to a higher time frame, let's go to the 15-minute. What we'll notice is that the first level, right, the second level of demand, we finally came into. And what is this essentially? Let's just look out to the higher time frame. So now that we're seeing an overall pullback, this is not just, oh, we broke structure to the downside, oh, we're just going to continue to fall. This is where we need to zoom back out to the higher time frames and see, okay, higher high, higher low, higher high, higher low. We can still look to buy it from that secondary position that hadn't been mitigated. Why? Because not only are we currently bullish, but we haven't come into objective. We haven't come into this level of interest. So we want to be able to push into that level. We have conviction behind that move. So when price finally pushes down into that level, fine, let's just say you don't take that trade. What I usually do is I have higher time frame levels via external structure and lower time frame levels via the internal structure, right? So we just looked at the higher time frame levels like we did here. That was a 1 point of interest. Obviously, we didn't get that entry. But secondly, we had this area of interest here, which you would have just placed a buy limit from that region. And obviously you wouldn't have had to deal with all the noise in here, but obviously the noise produced a lower time frame opportunity. So we can trade off the internal structure to get a much higher risk to reward. So what I do is I place half my risk right at the overall level, because from a psychological standpoint, now this is where traders oftentimes blow their account and lose and end up quitting or failing or whatever happens because they just trade the lower time frames. For one, you have to have a higher time frame perspective. You have to be able to distinguish what is going on the higher time frames versus what's going on in the lower time frames. The higher and lower time frames need to be in alignment with each other. Obviously, the lower the time frame you go, the more higher time frame confluences you'll need, right? So the reason why people fail is because they want to just trade every single solitary day and they just want to look for the lower time frame opportunities, because usually lower time frame opportunities present itself every day. But the psychological stress that goes into it is, let's just say, for instance, for an example, I know this one ended up working out, But let's say we pushed into it. Maybe we broke the lower time frame structure right here, but then we ended up continuing short, hitting your stop loss, and then continuing long. Because what this could have been was a lower low, lower high, lower low, lower high, lower low, then higher high formation. But you were, or I'm not saying you in particular, but just people in general would get so caught up in the lower time frame that they would lose on this position when someone who is just placing their buy limit order here and placing their stop maybe at the secondary position, right? They would be fine because they wouldn't have to worry about it. All the lower time frame noise that can go on before the overall move is seen, right? So that is why lower time frame trading requires more patience, and it actually requires more losses than wins. But the higher the risk to reward, still the overall profit, or the more profitable you can be. Meaning, it's okay to trade the lower time frames as long as you're building enough confluence, just like here. If this didn't work out, I would still attack the market the same exact way the next time because the same concepts applied, right? We came into the higher time frame structure. We broke lower time frame. We came into a level of rebalancing, or essentially the last selling volume on the 5-minute time frame that mitigated that demand. And we had an entry at 8:30 in the morning EST, which is prime New York session open. London, New York session crossover. So all the confluence is just like we traded the higher time frames, we can apply to the lower time frames. But the win rate goes down when trading the lower time frames because there are more opportunities. So you have to be psychologically sound to say, okay, I'm going to expect more losses. Am I going to be able to lose 4 or 5, maybe even 6 trades in a row before hitting that home run? Most people would be like, oh, I can do that and wait for a 1 to 25 or 1 to 24.5. Yeah, I can do that all day long. But can you though? Right? We can talk the talk, but can we actually walk the walk? Because I guarantee you, if you're risking, especially if you're over leveraging, but let's just say you're using good risk management. Even if you're risking 0.5% to 1% per trade, you're losing 4, 5, 6 times in a row. That creates so much psychological stress that it results in you feeding into that emotion and then over leveraging and then over trading and then revenge trading and all those simple things that can be completely avoided if we just have better psychology. But that's because we're trading the lower time frame. So that's what I do to avoid that psychological stress. I place half my risk at just the overall level. So like right in here, or like right in here, or even right in here, right? We obviously didn't come into it, but you know what I mean. Because if price were to just come into it and then it would just pushed up higher and there was no confirmation, like no lower time frame breaks of structure and a pullback to get in again, then at least I'm in the trade and I don't have to worry about it. If price ends up just absolutely tanking, well, I only lose half of my risk, right? But if we get the confirmation, then we can place the other half of our risk and then have a high risk to reward with it. Right? So that is why lower time frame trading, it requires more patience, it requires more confluences via looking at the higher time frames and all those confluences, but then scaling in and getting more confluences via the lower time frames. But it also requires really, really good psychology to do it consistently. And you have to be able to lose potentially even more than you win before hitting the home run trade, because it will come just like this one. Are you willing to lose, let's just say for this instance, right, 1 to 24.5, right? If we use half a risk, it's about 1 to 12. Are you willing to lose 11 trades in a row before hitting a 1 to 12? The answer is probably no. Even me, I'm not comfortable with that. Even though it would net me a net profit, I'm still not good with that because it just affects me too much psychologically. So that's why I like trading the higher time frames, but then scaling into a lower time frame after my first initial position from the higher time frame external structure is hit, I can scale in for better opportunities. So exactly right in here, that last sell to buy, so we had the first level, which we had to trade from. The secondary level, we finally came back down into having the understanding that we made a higher high, a higher low, a higher high. So we naturally expect an overall pullback, but we never came into this overall objective. So we can still be looking to buy upon overall pullbacks. And essentially, if we just pull a fib from the most recent low to the high, we're in discount, right? We're not trading off these fib levels because we need to be trading using price action, but we can use this as a measure to kind of distinguish the difference between, are we buying in discount or are we buying in premium? And obviously this is in premium. This is 71.78.6 retracement. And essentially we came into that fib level to the T. Anyways, so we come into that level 0.5% risk, so half risk on that position. And how do we get back into the market if there is a potential opportunity? Not always is there confirmation, right? So let's just go in here I'm going to use bar replay again, and let's scale into this position. And I'm just going to use the 5-minute time frame as a reference. You obviously need to be able to look at all the time frames, 4, 3, 2, 1, 6, 7, 8, 9, 10, right? So get TradingView Pro. I highly recommend it. You get to do that. But now we have the reaction from this level. So this doesn't mean that, oh, okay, we made a high, a low, a high, a low, a high. Just take it off the previous swing point. I mean, even if you did do that, I mean, you would have ended up winning the trade. But I don't recommend that. I recommend waiting for a solid reaction from the level. Write this down. A solid reaction from the level. Not just a little reaction right here or right here, right here. A solid reaction. Just use common sense, guys. A solid reaction, and then the failure to make a lower low, if we're buying, right? The failure to make a lower low, and then the next higher high. If you can get that, your chances of succeeding on this particular trade upon a pullback is 10 times better, right? 10 times more probable. So that's what we can do. You know, obviously, even if you did place a position here, right, you would have been fine if you placed your stop loss there, even potentially below that low. But let's just go based off of those simple rules. Right? So let's see this as a low, a high, the failure to make a lower low. This is not a higher high. We never closed above it. Here we closed above it. So this is the swing high. That's the new level. So the external structure, what is it? High, low, high, and obviously low and then a higher high. But what's the internal structure? What do we need to look for upon a pullback to get in at a more precise point? Well, let's look at the internal structure. High, low, high, low, high, low, high, and we came back down. So what we can be doing is placing our orders from the most recent swing point. So this is the previous low that made this high, but this is the overall low because we failed to generate a lower low here. We stopped and made that higher high. So this is the actual low that made that high. So we can be placing positions in here. We have, an imbalance, we have that sell to buy, we could place our orders like somewhere in here. Let's just go 977. That's the nearest psychological level. So let's just go right there. Stop loss where? Now, this is where it gets interesting. You don't want to be placing stop loss right here. I mean, you can, it's more risky, but the reason why I don't do that is because think about it from a higher time frame perspective. If you did, and just like we had here, is this a break of structure? No, it's not. We never closed below it. Even if we did, why would it still not be a break of structure? Because this is the structure here. High, low, this is what failed to generate the lower low. Then we made the higher high. So stops need to go below this low and not that low because this is essentially just an overall pullback, right, for a continuation higher. So where do we enter? Now we have we enter here. Let's just say that we wanted to enter further down. Right? We can also do the same thing right in here. This is the last selling volume, essentially, right? Because we failed to make a lower low. We retraced. We could have made a lower low here, but we stopped. Right? That was the last selling volume before we pushed up. So that could have been your entry. Well, essentially, we're in here, right in there. Stop loss below that level. But let's just say we entered right there, okay? Just for, worst case scenario, let's just call it. Stop loss would then go below that low here. So let's just call it 27.5 pips. Let's just round it off. And the same can apply. Now we have come into external structure. Internal structure is now bullish because we have confirmed through the lower time frame breaks of structure. So now where do we take it? Well, now we can take it to our higher time frame level here. And let's just call it 1.0104, something like that. That's, again, a 1 to 12. If you risked 0.5% on it, that's 6%. If you risked a full percent on it, that's 12%. Boom, you could have passed your prop firm challenge. Even if you didn't right here, let's say you didn't take that trade, you could have passed it right here with that trade. And let's just play it out. And as we're playing that out, how do we manage the position? And this is very important. Trade management is very crucial. Ask yourself the simple question. If you get into a position, obviously in this case it's long, where could we be potentially looking for, not necessarily shorts, like we're not going to be looking to short this, but where could price reverse against my trade? And at that point, you just look at the counter trend, right? We can see here clearly, high here, we had a clear buy to sell. So we could pull back into that level for continuations. Obviously, I'm not going to be selling there because we came into a higher time frame level. But where do we need to be securing partials, right? At least partials. And that would be here. The huge buy to sell, that's the repricing, the last buying volume before the sell-off. So that's exactly where I would have been taking partials on this particular position. We can see we did come into that level. We did actually come into that, and we had a reaction from it. So that's why it's so important to split up your positions. If you have, let's say that's TP1, TP2 could be maybe at the previous high, But since this level is so close, I probably would have only had 2 TPs, one right here and then one at the overall level. So that means I would have placed 2 positions, each of them on half risk, right? Because the same entry, the same stop loss, different take profit. So you can take profit automatically instead of having to worry about taking profit manually, to where if price, you were sleeping and then price is all the way down here now, you could have taken partials here, but now you're taking partials here back at break even. You know why it's so important to do that. So we can't be lazy when it comes down to trade management as well. So we can see here, it's just right about to approach. So that's exactly where we would be looking to take our profit. All right, and this is going to be in a matter of almost about 4.5 days. It'll probably shoot up here in a little bit. We'll give it a couple more seconds here, but this is what, so far, 5 days, 6 days, boom, 6 days, 1 hour. In a matter of a week's time, you have made 12%. And that's why it's okay to be patient. You have your higher time frame objectives, but you have your lower time frame partials regions as well. So ladies and gentlemen, this is exactly how I go about breaking down the charts from a higher time frame perspective, but at the same time, scaling in and scalping smart money concepts. All we have to do is just use the same concepts being taught on the higher time frames as the lower time frames. So guys, happy Valentine's Day. I hope you guys are having a great day so far. If you guys are watching this over the weekend, have a great restful weekend and stay tuned for more videos like this. Take care.
Hey folks, ever wonder what broker I use? Well, I use HenkoTrade. It was a no-brainer because I was looking for a broker with good trading conditions and one that wouldn't restrict my leverage. Now, by joining HenkoTrade, I've also cut down my trading costs significantly with their super low commission of just $1 per 100K. You can learn more at henkotrade.com or just click the link I've put in the description.